Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about if a banking collapse could possibly happen and how that would affect real estate.
Very good question. So that's been in the news a lot in the last couple of days with the Silicon Valley Bank
Okay.
having had some difficulties, to put it mildly.
So let's do this. Let's talk about Silicon Valley Bank and what ecosystem that lives in and why that happened. And then let's talk about maybe the threat to regional banks and then the banking system as a whole, whether this could spread to the big banks. And then we'll talk about real estate and how this maybe affects real estate. Because what was interesting is with Silicon Valley Bank, one of the assets that they owned was a bunch of mortgage-backed securities.
Right.
Right.
So,
First of all, Silicon Valley Bank, what kind of bank is it and who is their customer?
So that's a good question. So Silicon Valley Bank is, it's not a teensy-weensy bank. I mean, it is a good-sized bank, right? And their primary customers are people and entities in Silicon Valley. So there are a lot of startups. There are a lot of venture funds.
Okay.
And there are a lot of people who either work for them or work in the area, and they have their checking account there. That's how they pay their rent, their mortgage, their car payment, whatever. So, the primary concern right now is that the immediate concern is you've got companies that have their money in there, and because the bank has been seized by the FDIC, all the accounts are frozen. So that means that that companies can't make payroll because their bank accounts are frozen. That regular people can't make their mortgage payment, can't draw money to put gas in the car, can't do anything because all the accounts are frozen. So in the short term, this is a lot of pain for a lot of people. In the longer term, most people, certainly individual depositors that have funds less than $250,000 will get their money and it'll be fine. But in the meantime, over the weekend they can't hit the ATM, right, and get money. Their debit cards don't work to go buy groceries. So this is a really big deal.
Okay, well let's take it on the next level now. What about all these companies that just raised $10-15 million round? All the money they're using to pay their employees, to pay for advertising and everything they're paying for, if they can't pay for any of that, what's going to happen? Because now there's downline effects.
Right. So my concern is actually greater than that.
Okay.
So yes, so you're right. These companies can't pay their employees. They can't make payroll. They can't pay rent, and so on. They can't pay their vendors. Yes, that's a concern. But my bigger concern is that these companies have raised money so that they'll have a runway of 30 months, something like that. And that money was in Silicon Valley Bank. So now that money, depending on what happens, is gone. So they've gone out and they've raised this money so they would have this runway, and it's gone.
And these companies might be developing some breast cancer, testing thing, or
Right.
some, something in healthcare, something in technology, something that makes our lives easier. And disrupting this has long-term effects.
Right. I mean, this is not about Angry Birds, people, okay?
Yeah, right.
This is about really important work being done. This is about, the last 10 years of work in Silicon Valley that these companies have been doing that could just evaporate.
Right. And then also there's a bunch of funds who potentially wouldn't be able to make loans
Right.
out. So this basically is what happened. You had a bunch of years of very good times for venture capital. People were, like us, were putting money into venture capital funds and investing in startups. And a lot of these startups were bringing in money. And then you've had the last really year where a lot of money hasn't been raised. But what's happened is the startups are starting to spend the money now that they've been raising to operate and stuff. And so the bank went out and they took this $180 billion that was in the accounts as deposits, and they went and made investments. And they invested in mortgage-backed securities. They invested in treasury bills that paid 1.5–2%, because at the time that was kind of the going rate. And they sort of locked up all their money in these investments. So what happened was someone last week, they decided that they needed more liquidity. So they went and sold a bunch of these mortgage-backed securities and treasury bills at a discount, lost $1.8 billion because they were having a liquidity crisis. What happened was word got out. Now, Silicon Valley is unique. Why is it a unique ecosystem versus Bank of Nevada or some other regional bank?
So it's unique because for lack of a better word, they're very incestuous, right?
Okay.
They're all very connected. So once somebody catches wind of something, it goes in the group chat, so to speak, and it just blows up all over the place. And so that's kind of what happened. So the president of the bank came out and said, "Hey, we need to get some liquidity, and we're doing this." And then other people looked at it and went, "Holy crap! We're going to go ahead and get our money out." So the more people said, "Hey, I saw this, I'm getting my money out," and sharing that with their friends, the more people were getting their money out, so that this caused a run on the bank.
Okay, it was a run on the bank.
Yes.
It was a run on the bank. Okay. Run on the bank. They took out basically about 25% of all
right.
cash the bank had,
right.
of all deposits.
But what I want to kind of back up to, it's not that the bank was originally insolvent. So at the beginning of last week, this bank was not insolvent. That was not the problem.
Right.
The problem is that people panicked. So when people panicked, that's what made the bank insolvent. The bank did not start out being insolvent last week.
Okay. They did make some, probably in retrospect, not great investments. So I'll put up the slide. Right. This is their off-balance sheet investments that they have. As you can see, a lot of this is in technology, early stage technology. They're very heavily in technology. The problem with these investing in startups is it takes a long time to get your money back out. So if they need liquidity, they can't get it. The only way they can get liquidity is selling more liquid things, mortgage-backed securities, things like that. The problem is, we'll talk about mortgage-backed securities because that's real estate, and then we'll talk about other banks, and then we'll go more into real estate. So when if you bought a mortgage-backed security a few years ago, you probably got 2.75% interest rate. That's what your investment is. So if you bought $100 million of these mortgage-backed securities, you're only expecting 2.75% return because that was the going rate at the time, right? The problem is that's not a good going rate anymore. You could take your money and get over 4% just buying government T-bills, right? So you wouldn't really want it. Like, there is no market for these 2.25%, whatever percent MBSs. There's no market for them. And the mortgage-backed securities are just all of your mortgages put in a portfolio and sold to somebody, right? So what happens if they sell those? Does that mean the people on the other end have to sell, they get foreclosed, or what happens?
No, this has nothing to do with them. Okay, so it's kind of like when you're this happens a lot. Your loan is sold from Bank A to Bank B. It doesn't make any difference to you. The only difference may be that you may get a new loan number and you may get a new place to send your money. That's it. Other than that, it does not change the agreement. It does not change your loan documents as far as what your commitment is regarding the payment of the loan. So no, it has no impact on the people whose mortgages this bank issued. So that's not really the issue. The bigger issue, I think, is that a lot of people are going to be looking at what happened here and taking a closer look at other banking institutions.
Okay, we're going to get to that next. So let's talk about systemic banking. Is there a problem with banking? The first chart here, this is the U.S. bank Tier 1 capital ratios. This is a top tier of banks. And as you can see, this is a timeline, goes back to 91. The higher up on the chart the Tier 1 banks are, the safer they are, because it means that they have higher percentage of capital as a percent of risk-weighted assets. So if you look down, they were below 10% great financial crisis back around 2009. And then TARP showed up and all these rules changed, and it instantly got better over about 3 or 4 years. And as you can see, the trend has been banks have been doing much better with not keeping heavily risk-weighted assets. Now, some of this was they had a lot of these high-risk mortgage debts. That's really what caused the financial crisis. You had overbuilding, these subprime lenders, and all these junk real estate assets that they were holding on to, and they were high-risk assets that were not really performing very well. They've gotten rid of all that. They've cleaned up their act. Basically, all real estate's A paper. That's why this looks the way it does. So from a global perspective, the banking system is basically pretty safe, right?
Okay, so I'm going to answer that in a different way, though. Okay, Silicon Valley Bank, on paper, was perfectly safe. Okay?
Sure.
And this is where we are.
But
so
even Wells Fargo could be run if everyone got together and tried to pull their money out.
Yes.
Right.
But so what I want to say is that even though the banking rules have changed and regulators have done a better job, there are still portions of the banking system that could be better, that could be regulated differently. So, we kind of talked about that a little while ago. It has to do with how they're looking at their portfolios and when or if they're even reevaluating the value of that portfolio, right?
Oh, like mark to market?
Yes.
Okay. That's an interesting topic. We'll talk about that after this next slide. This is the loan to deposit ratio for all commercial banks. Now, what you don't want to be is high up on this list. If you see really high, that means they're over leveraged. They have more loans out than they have actual deposits. And as you can see, if you look back up on there, that second highest peak is Great Financial Crisis, of course. Then you see banking regulation. And the bottom of that's actually COVID. Because what happened was people weren't buying cars, people weren't buying houses, but people were still getting paid and money was flowing into accounts. So we reached a low, and actually we're still historically super low. The banks still have a very high, historically high percentage of deposits for loans they have out, which is good. Okay, but let's talk about what you just said, because I think that's very interesting.
Yeah. So, so big banks, so the Chase, the JP Morgans, the Wells Fargos, they are in a much better position on paper. I'm going to quantify that on paper, as far as how they are, how their assets are allocated and how safe the deposits are, right? And then you're looking at smaller banks like Silicon Valley Bank, which is not a tiny bank by any means, but it is a smaller bank when you compare it to a Wells Fargo or something like that.
It's a top 20 bank, but
right.
It's like airlines. If you're the 20th biggest airline, nobody's ever heard of you.
Right. So what's happening is, like Todd said, they were investing in startups, they were investing in all these things, and not all of these are liquid. And not only that, but as the values of these assets are changing, they are not rebooking them on their books. So they're still at the original valuation. And so that changes really what how much money this bank has in assets, right? Because you buy here, if the value is now here, but you're still showing up here, that's a problem.
If you're loaning on that too, if you're saying, look, we have all these assets that are, mortgage-backed securities and investments in startups and all these other venture debt that we have out there. So, and it's worth X, it's worth $20 billion. So we're going to loan out another $20 billion. They just make up the money, borrow it from the Federal Reserve overnight, loan it out, and they put on their books. They say, we have all these loans, we originate all these loans. But the problem is they become over leveraged.
Right.
And they were actually the most over leveraged bank in the country by about 50%. Like, it was a substantial number, how over leveraged they were. So that was sort of like you take kindling and stack it up and you put a match on it. So the real risk is that people hear of this and then they go out to Bank of Nevada tomorrow and they pull all their money out because now they believe there's a regional banking crisis, and they pull it out and go put it in Wells Fargo or Chase or Bank of America.
Right. So that's a really big problem. And then, of course, when you're looking at this, you think you're all of a sudden looking at, well, what else, what other paper are they holding? Well, they're holding mortgages, fine. So then what happens if the value of homes changes? Is that going to cause a greater banking crisis across the board? Because, you're loaning at, let's say, that the house is worth $500,000, the house is now worth $400,000, and that there isn't $400,000 worth of somebody owes $450 on it, so now they're upside down. So now we're getting back into what happened in the Great Financial Crisis. We're not at that point yet. So I wanted to address this because it's going to come up in the comments. So I may as well just kind of nip it in the bud.
And something too is, remember, when those loans were originated, the guarantee is based on whatever price they originate at. It's not based on the home value. The risk is that the home gets foreclosed,
right,
and they can't get the value back. Right now, that is not on the horizon. There is no risk because 40% of all homes are cash. Then the other 45% are at basically sub 3% rates. And then you have about 5% of all loans that are basically, call it over 4.
Right. And then remember, most loans are assumable. So if somebody does need to sell their house, somebody's going to want to buy that house and assume that loan. So this is a lot different situation than it was during the housing crash. So that's why I want to bring this up, because I know it's going to come up in the comments. So I want to make sure that we address it.
The other thing too is in the I read a thing where somebody basically said, well, the banking system is what caused the housing crash failure. No. Great financial crisis didn't happen until 2009. That it was caused by real estate subprime loans, period, end of story, and all the ridiculous types of credit default swaps and things that were built on top of that, fake ecosystem of these, super risky loans. It's literally the opposite now. There's not a risk that real estate is going to cause a crash or anything in the financial markets, and financial banking institutions not going to cause anything to happen to real estate. That's the whole reason these mortgage-backed securities are traded. They're separate and securitized separately. They're not really interconnected. The only way they're interconnected is through foreclosure risk, which doesn't happen right now.
Right. So, is there a way to basically make it all good again? And the short answer is yes. Okay.
Oh, you're talking about Silicon Valley Bank.
Right.
Because this is about two things. It's about restoring the depositors' monies and about making the public feel secure in their regional bank. Because regional banks have advantages over big banks, because if banks get big, then they take advantage of you. And regional banks, sometimes if you're doing a business bank or whatever, they have perks. They're cheaper to operate at than usually the bigger banks.
Right. So this happened, back in 2009. It actually happened to us. So we, a bank that we banked at, this happened, and what the Federal Reserve did at the time, they did the same thing. They went ahead and they seized the bank, and then they went ahead and worked out a deal with another bank, who then took over this bank
over the weekend,
and made everybody good. So which was great,
because the limit was. Yes. Was it 250 or 100?
Right. So
no, it was 100 then.
It was 100 then. But the point is that there were lots of people who would have been hurt, individuals, businesses. So that would have been really bad.
Us.
Yes, us too. And that would have been really bad. But the Federal Reserve is experienced in matters like this and can make this good. And we're hoping that they will. We're hoping that they will find a bank to take over Silicon Valley Bank by Monday, and everything will be up and running again, and everything will be good again. This is very possible. And this does not mean a taxpayer bailout. So I want to kind of emphasize that. This is not a taxpayer bailout. This is the federal government saying, hey, ABC Bank is going to come in and take over Silicon Valley Bank. They're going to make everybody good. And ABC Bank, if you're short any money at the end of the day, we'll come in and we'll make up the shortfall. That's the way that works. So this is good for everybody. Now, the reason this is really good, not just for the people involved with Silicon Valley Bank, I really want to emphasize this, because it's not about just the businesses and individuals that have money or depend on the money in Silicon Valley Bank. This is good for regional banking in general, because what we don't want is other people getting nervous and pulling their money out of other banks and causing runs on other banks, because then it does become a systemic failure, and that becomes something bigger than maybe the Federal Reserve could even handle. So this, or the system could handle.
FDIC for sure couldn't handle it. So here's the interesting thing. People don't remember this. Everyone talks about the bailouts, but the government made money.
Yes.
Because the amount of money they loaned was paid back and more, because all they did was they basically securitized all the mortgages, which eventually either were all paid off or purchased or whatever, and they actually made money. Like the federal government made like $40 billion of profit.
Right.
So it's like literally one of the best investments they made was the bailout. It wasn't really a taxpayer bailout.
So what you have to understand about this is that all the government has to do is say, we will back this. They don't actually have to put any money on the table.
Right. Yeah.
They just say, we will back this, and that makes everything stop.
Okay. How does this affect real estate? Because there are people out there who maybe they're thinking of selling, they're thinking of buying. Let's talk about this from a global perspective. If people think their money isn't safe in a bank, and they don't start to trust the banking system, what type of decisions maybe do they start to make with their cash? Like they just pull their the money out of the bank, and what do they do with it?
Right. So that's a really good point. We've talked about this a lot, that real estate is a tangible asset, right? Everybody has to live somewhere. And, unless there's some natural disaster and the real estate gets wiped out, it's an asset. So no matter what happens out in the real world with money, you still have the structure, right? You still have the land or whatever it is that you own. And so it's a tangible asset. So I think you're going to see a lot of people, and maybe some older people who do not have the possibility of making up money again, maybe looking at this, and not necessarily that they're in a small bank. You know, they might be in, you know, J.P. Morgan Chase or some big bank, and saying, hey, you know what? I might take some of that money out and put it in a house because I don't trust banks. This is really...
You have to rely on the bank. When you give money to a bank, you're loaning it to them, and then you're hoping they pay you back. It's not really your money. That investment the bank makes in that money market is in their name. It's not in your name.
Right. And you know, and that's what happened with the sweep accounts, and so it's a whole big mess.
Okay.
But the bottom line is that a lot of people are looking at this, and people get skittish. And when people get skittish, they pulled money out of the bank. Well, they're going to do the same thing from their bank. But where are they going to put their money? Are they going to put it in a Wells Fargo or J.P. Morgan Chase, or are they going to put it in a tangible asset like a house? So, our contention is that certainly not everybody, but a few people will do that. And if enough people do that, then that obviously gives a lot more support to the real estate market. You know, we're already in that situation where it's a spring buying season, so we have more buyers than sellers, and so it's getting a little heated out there. So if you have these people who are now getting nervous about their money in the bank, and they're entering the market to buy houses, they're going to be buying them cash, so they're not subject to the interest rates, and they're not going to be necessarily as sensitive to prices because they're trying to protect the money they have. So they're, if they're paying a few $1,000s more for the house, they're okay with that because they're looking at saving the whole thing rather than, wasting a few $1,000s.
If you're hearing or whatever that, this will cause the real estate to collapse, there's no connection. Like, they're not physically connected in that way. They don't really work that way.
No, they are connected in the sense of people taking money out of the bank to put it in real estate, though.
Right. And it's not like, if the banks go away, they won't be able to give loans on real estate, et cetera. But banking's not going away. Silicon Valley did own mortgage-backed securities, but most of those mortgages that they had were either they had purchased them from somewhere else, they invested in them, or they were the ones they'd originated for people that are members of their bank. So startup founders, employees at startups, and depositors, basically, people that work at venture capital firms, and all those people. One problem with that could be regional, because where all those people buying houses are buying them in the Bay Area. So if you looked at Silicon Valley's footprint of all the loans they've made on homes, they're probably all in the area, which is, you never want that. Could you imagine being a bank and only making your loans in Florida, and then a hurricane comes through and wipes out all the houses, and the people just go, hey, we're not going to pay any mortgages, and then you can foreclose, but you can't sell them because now you have this piece of land. There's no, you just wiped yourself out, which is why mortgage-backed securities usually are homes. Like, if you look at a portfolio, they're houses all over the U.S. So it's hopefully Silicon Valley Bank didn't just have a huge portfolio of houses in San Francisco. That market's been kind of taking. It's probably the highest depreciating market in the U.S. And so there could be some foreclosure risk there, especially if this ecosystem gets wiped out. Right. So we have to hope that what happens over the weekend.
Right. So
what happened? What's the goal? The
goal is that the FDIC finds a buyer for Silicon Valley Bank, and that they guarantee this buyer that whatever shortage there might be, that the FDIC will make up the difference.
And I think that's going to happen 100%, because even though they made some bad decisions, they're still financially sound on paper, minus the fact that their deposits were all, there was a run on the bank.
Right.
And investors will want to come in. They may not get a substantial discount, but they will be able to take the assets. I think the people that are going to be in trouble were the people who own stock in Silicon Valley Bank. I think those people are going to be wiped out, and all the people that work there, unfortunately, they may get repurposed in the new version of the bank. But the if you own stock in that bank, it's probably gone. The share price has already been wiped out, 86% of it wiped out in the last 2 days. Right.
So, in conclusion.
All right.
Silicon Valley Bank, we wish you luck over the weekend.
All the startups, all the funds.
We've
been waiting for the
hearts go out to you.
emails from startups we've invested in to find out if they have exposure.
Yeah. So startups, anybody whose money is in there to do payroll, and there are payroll companies whose money was in there too. Yep. So there are all kinds of people that are getting hurt this weekend. We're very sorry for you, and we're hoping that all this gets resolved over the weekend. As far as opportunities in real estate, there are always opportunities.
Yes.
And it'll be interesting to see, over the next few months, how this actually echoes through the market, because it won't just be in that market, it'll be throughout the country.
It's possible.
Because everybody's watching this. So like I said, you're going to have people, particularly people in their maybe 50s, 60s, 70s, that are going to pull some money out and go into real estate so that they can safeguard some of their cash. So it'll be interesting to see what happens. Yeah. Please leave us some comments and tell us what you think. Tell us if you have had any experiences like this. Like we said, we did, and it was stressful. It was a very stressful weekend. So we're interested in finding out your experience. Please let us know. If you thought this video was interesting, if it addressed something that you were interested in learning about, or if you would like for us to address something new, please like the video, share the video, subscribe, hit the notification bell, and we'll see you on the next video. Bye.
Bye.